In this video, we are going to see about two popular ways of investing in stock market. If you are actively investing, you will fall into any one of this category. So watch till the very end of this video to find which one is better. One ideology that focuses upon the growth of the company and other upon the value of the company, so that growth stocks are considered to be rabbits in the race, whereas value is considered to be slow and steady approach. To identify the difference between growth stock versus value stock, you need to understand these three factors. First one is the growth of the company, that is understanding how profitable the company is, how is cash flowing in the company, which acts as a number one priority for growth stocks. Growth investors are trying to invest in a company that are growing faster than Nifty and Sensex in an ambition to earn more than normal. It is like finding the next big thing that has a lot of attention in the market. These investors usually pick a stock that gives a return around 20% or more over an year. Due to these reasons, these companies are mostly small or mid-cap segment, which is potentially in its growing range. The complete opposite is value investor, who tends to invest in well-developed and pretty boring large-cap industry. This doesn't mean that value investors don't want high returns in their position, but well-developed company is the number one criteria to pick up the stock for value investment. But it is important to consider the second factor, stock's valuation. Sometimes in market, the company is undervalued than its actual value due to some temporary problems in the company. But you understand the company and the management is good. So you invest in that company hoping that the stock prices will revive to its original position. It is that time when value investors put all their money in an undervalued company, hoping that it will go to its actual value and exit out of their position with a higher profit. It was mostly popularized by Warren Buffett. There are many ways to determine the value of stock, but PE ratio is the best way to find the stock's value. It tells the investor how much they are paying for every 1 rupee profit. It can be compared to its peers or market as a whole by comparing it to its indexes and can find the value of the stock. So, the value investor's main motive is to get the best company share at a very cheap price, whereas growth stock, on the other hand, tend to be higher price for the growing company. So, the growth of the company and stock's valuation are two key characteristics of the value and growth investing. Final differentiating characteristic is stock's volatility. It is always looked upon as far as any type of investment is considered. Growth companies tend to be more volatile, that is, it can return 30% growth in a year and minus 40% in the next year and 60% in the following year. Whereas value investing is quite simple, it averages at a return of 10% every year. So both approaches has its own advantage and disadvantage. For growth companies, the main advantage is higher return, but the disadvantage is more volatility and mainly focuses upon small cap segment. If the people don't accept the upcoming technology or the big thing that industry creates, the small cap or mid cap segment is more vulnerable to get bankrupt. As far as value investing is considered, the main advantage is the less risk involved with its investment, because we invest in a well established large cap companies that earns you a consistent profit. But the problem with the value investment is falling prey to the value trap. That is, if you find a low value stock but the problem is bigger than you thought, so the value keeps on decreasing. So in order to earn what you have invested in the share, it may take decades or even more than a decade, which is not probably good when considering it as an investment. Both approach has its own advantage and disadvantage. So my advice is to have both growth and value stocks in your portfolio, so that you won't miss your fortune when the next big thing happens, and also you have good returns consistently. So if you watched the video until here, like and subscribe would be massively appreciated. And to understand some terms mentioned above like PE ratio, and other basics about stock market, click the playlist right here.